Imagine the world stands still for a moment. Sirens wail in distant cities, oil prices spike overnight, and breaking news banners bleed across every screen. Somewhere far from the front lines, a hand trembles. Not over a trigger, but a mouse pad, hovering over the sell button. War has begun. But here's the paradox. While bombs fall and uncertainty explodes across borders, the stock market doesn't always follow suit. Sometimes it dips, sometimes it shrugs, sometimes it rises. It's a contradiction that stuns economists and traders alike. Because when nations go to war, we expect panic. But markets, they've got their own logic. So, what does really happen when war erupts? What signals should smart investors watch for? Let's uncover the 5 most critical and surprising market shifts that tend to unfold when the world goes to war. 1. Markets react sharply to uncertainty, not just to war. When war breaks out, it's not just bombs that drop. Stock markets often fall first. But here's the twist. It's not always the war itself that causes the panic. It's the uncertainty leading up to it. Investors hate unknowns more than bad news. That what-if sentiment is like poison to market stability. Before Russia invaded Ukraine in 2022, global markets were already jittery. On the day of the invasion, the S&P 500 plunged more than 7% within days. But oddly enough, just a month later, it rebounded, higher than before the conflict even started. The same pattern showed up during the Gulf War, the Israel-Hamas conflict, and even back during World War II. The idea that war equals instant doom for markets? It doesn't hold up. In fact, World War II saw US stocks rise 50% from start to finish. The lesson? Markets typically price in risk fast. The initial shock is steep, but recovery can come quicker than expected if the conflict remains contained and predictable. Still, in the first moments of war, fear dominates logic. Institutional traders flee to cash or gold. Retail investors hold their breath. Volatility spikes. In this window of fog and fear, even strong stocks dip. Not because their fundamentals change, but because perception does. That's why the early days of war are often the most brutal for equities. But they also offer opportunity to long-term investors who understand that markets rebound once the uncertainty clears. 2. Defense, energy, and safe haven assets surge. When war knocks on the door, 3 sectors are already wide awake: defense, energy, and safe haven assets. It's predictable, almost mechanical. First up, defense stocks. Companies like Lockheed Martin, Raytheon, and Northrop Grumman are often the first to rally. Why? Because war increases demand for weapons, surveillance systems, and military logistics. Governments start signing billion-dollar contracts overnight. During the Ukraine conflict, European defense spending exploded, and so did these companies' stock prices. Next comes energy. War usually threatens oil supplies, whether it's the Strait of Hormuz, Russian gas pipelines, or Middle Eastern oil fields. Any conflict near energy infrastructure sends prices soaring. When Russia invaded Ukraine, oil shot past $100 a barrel. Investors know this. Energy companies often outperform during war because supply fears drive profit margins through the roof. And then there's gold, the old reliable vault of safety. Every time a geopolitical tremor shakes the globe, gold prices rise. In modern markets, you'll also see spikes in the US dollar, Swiss francs, and even cryptocurrencies like Bitcoin. Investors rush into these safe havens, not because they're guaranteed returns, but because they offer emotional comfort in chaos. Even during the recent Israel-Hamas war, the S&P 500 dipped for a day, but gold and oil edged upward within hours. That's how fast money moves in wartime. The takeaway? War creates an investment split. While general markets may dip, strategic sectors surge. It's not about fear or greed, it's just historical pattern and economic logic. And if you're watching the right assets, war isn't only a risk, it's also a signal. 3. Inflation and supply chain disruptions. Spike. War doesn't just break peace, it breaks supply chains. And when that happens, inflation becomes the silent second front. Take Russia's invasion of Ukraine. Together, those two nations supplied nearly a third of the world's wheat and a major chunk of global fertilizer. When ports like Odessa were blocked, wheat shipments froze. African and Middle Eastern countries relying on these exports faced immediate food shortages, and prices globally soared. The same goes for oil, metals, and rare earth minerals. Wars often occur in resource-rich areas, and any threat to mining, drilling, or shipping sends commodity prices flying. Remember, markets don't wait for actual shortages. They react to the possibility of disruption. Inflation isn't just about price tags going up. It tightens interest rates, spooks central banks, and slows growth. The Ukraine war didn't just raise fuel prices, it forced central banks across Europe to rethink their entire monetary policy. And inflation triggered by war tends to be stubborn because the root cause, supply shock, can't be fixed by rate hikes alone. Plus, there's the psychological inflation. People expect prices to rise during war, so they start panic buying. That behavior alone adds fuel to the fire. Let's not forget logistics. When the trade routes are blocked, think Black Sea ports or Red Sea choke points. It's not just a shipping problem, it becomes a global pricing problem. From grains to semiconductors, everything gets delayed or rerouted, adding time, cost, and risk. Bottom line, war is inflationary by nature. It makes everything more expensive, not just for the countries involved, but for everyone linked through global trade. And in a tightly interconnected economy, that's basically all of us. 4. Markets. Often rebound, faster than you think. Here's a truth most people ignore. Markets are more emotionally stable than investors. Shocking, right? We assume that wars should drag markets into the mud for years, but history disagrees. Let's rewind to World War II. After the Pearl Harbor attack in 1941, the Dow dropped nearly 3% overnight, but within a month, it had recovered all losses. From 1939 to 1945, during the height of global bloodshed, the US stock market gained over 50%. That's not resilience. That's astonishing. Same with more recent conflicts. The Vietnam War sparked inflation and political unrest, yet US markets averaged 7% returns. During the Cold War, despite decades of nuclear tension, the S&P 500 returned nearly 10% annually. Even modern wars follow the same rhythm. After the 2022 Ukraine invasion, global markets sank, but within weeks the S&P 500 was up. After 9/11, Wall Street closed for 4 days and dropped sharply, but it rebounded in less than a month. What gives? Markets are forward-looking. They don't care about fear, they care about fundamentals. Once the scope of a war is understood, how big, how long, who's involved, the uncertainty fades and rational pricing returns. Another factor, war often leads to government spending, which can actually stimulate certain sectors. That influx of capital, especially in defense, infrastructure, and manufacturing, boosts corporate profits and investor sentiment. So while the human cost of war is tragic, the financial markets often treat it as a temporary storm, and once that storm is measured, mapped, and priced in, the skies tend to clear fast. 5. Diversification and long-term thinking. Win the war. In times of war, panic is contagious, but patience is profitable. History shows us that trying to time the market during geopolitical crises is usually a losing game. Most of the biggest market crashes, like the 1929 Great Depression or the 2008 financial crisis, didn't happen during wars. They happened in times of peace when no one was looking. So what works? Diversification. During World War II, countries like Germany and Japan saw their markets lose up to 99% of their value. But US and UK markets delivered strong, positive returns. Global investors who spread their exposure across regions suffered far less damage than those concentrated in a single country. The rational reminders analysis backs this up. Diversified portfolios outperformed during wartime, not because they dodged losses entirely, but because they spread risk. It's like financial camouflage. No single bullet can destroy your entire position. Also, avoid emotional trading. Most retail investors who sell during the early panic of war miss the recovery entirely. The best course? Stick to your asset allocation, rebalance if necessary, and ride the storm. Long-term strategy beats short-term panic every time. War is terrifying, but so is selling low and buying high. The market, much like history, is full of surprises, and more often than not, it rewards the calm and punishes the reactive. So whether you're 25 or 65, whether it's a border skirmish or a full-blown conflict, your best weapon isn't cash or gold. It's time, discipline, and diversification. Bonus insight: timing the market during war? Don't. A quick note for the would-be market timers: don't try to outsmart war. Historically, investors who tried to jump in or out during conflict almost always miss the boat. Why? Because the biggest crashes didn't happen during war, they happened during peace. Think about it. The 1929 Great Depression, the 2008 financial crisis. Both peaceful periods, yet catastrophic for markets. So, while it's tempting to panic buy gold or dump all your stocks at the first whiff of war, data suggests this is rarely a smart move. A globally diversified portfolio and a steady hand beat war-fueled impulsivity every time. Real talk: what should you do as an investor? Here's the honest answer: nothing drastic. If you're a long-term investor with a balanced, diversified portfolio, keep your course. Wars come and go, markets dip and recover. Trying to war-proof your entire strategy can do more harm than good, but do stay informed. Watch how your assets are exposed to geopolitical risk. Maybe tilt a bit more towards sectors like defense, healthcare, or energy if tensions rise. But don't build a bunker out of your brokerage account. And whatever you do, don't sell based on fear. Wars test nations, but they also test our patience, our panic levels, and our portfolios. Yes, the headlines will scream. The charts will wobble. But if history has taught us anything, it's this: markets may fear uncertainty, but they're built to survive conflict. So instead of reacting emotionally, think strategically. Focus on fundamentals, diversify like you mean it, and stay invested for the long haul. If this video helped you see war through the lens of markets, give it a like, tap that subscribe button, and hit the bell icon so you never miss insight like this again. And hey, share this with a friend who thinks every war means a stock market crash. Because fear is contagious. But knowledge? That's power.